Since quite some time, I have been interviewing our analysts and editors on the bearish mood of the markets. Now, the one question on everybody's mind is when will this bear market end? The situation doesn't seem to be improving. In fact, market participants have been pressing the panic button on global recession fears. Well, Vijay Bhambwani is back again with us to talk about more on this. Hi Vijay sir, thanks so much for joining in once again. So sir, last time we spoke on rupee, and you told that rupee might fall further, and it did fell the next day immediately. So sir, what is all this signaling? And also I read one of your article in which you've mentioned that you are also anticipating recession. So what are the signs that you are seeing? Where are we headed?
Thank you so much, Rini, for inviting me again on your show. It's such a pleasure and privilege to address our Equity Master subscribers. Well, I would begin with a slew of evidence to basically buttress my argument that we are headed towards a recession. The first and foremost is the bond yield signal. Now, bonds, especially sovereign bonds, bonds that are guaranteed by the central government of any country, are a safe haven. And the more people buy bonds, the further the yield falls. Because the price of the bond is bid above its issue price, therefore the yield starts to fall. We have more than 1.5 dozen countries where bond yields are now firmly into negative territory, which means if you were to invest money in that bond, not only do you not get returns, but you actually have to pay to keep your money safe. Now, this is in line with certain countries like Denmark, which are already offering you negative interest rates on even fixed deposits. This is my first argument. The second argument is whenever historically mankind has seen any kind of threat perception or have felt that their financial assets are going to give lower and lower returns, if not negative returns, they have chosen to go towards the relative safety of bullion. Now, as you have seen, gold prices over the last 9 weeks have been appreciating. This is my second weight of evidence. The third one is from the commodity markets. In spite of the fact that the US crude oil inventory has fallen approximately 10% in the last 10 or 11 weeks, we are seeing crude prices being sluggish. The second commodity indicator that I would look at is copper. Copper is also known as Dr. Copper or the tin roof of the economy. There is very little infrastructure or construction space, automobiles, electrics, electronics, where copper is not used. In spite of the fact that the governments world over are talking about all is well, the price of copper on the commodity exchanges seem extremely sluggish. Take a look at other industrial metals, lead, zinc, aluminium. They're all showing signs of sluggishness. So if at all factories are churning out more and more goods, why are industrial metal prices falling? And the last but not the least is currencies. The emerging market currencies, the Southeast Asian currencies, they are all basically showing signs of weakness against the US dollar. The US dollar remains a bastion of safety or a safe haven currency. If all else fail, currency traders tend to flock towards the US dollar. And the US dollar index almost came into kissing distance of 99 a fortnight ago. And it is still trading at 98.25 odd levels. Now, these four points, what I would call weight of evidence, seems to suggest that financial market returns are likely to contract even more further.
So, sir, keeping all these signals in mind, for how long do you think will this recession last?
Rennie, there is an old story, if you permit me, I would like to narrate. In the 1960s, the Church of England wanted to invest money in the equity markets. This was post Second World War. There was a recession, and the Church of England wanted to be very, very careful about deploying its money. So they had a condition. The fund manager who would undertake to take this offer of handling the church's money would not get any fees because this was God's work. Secondly, and more importantly, you cannot lose God's money, right? So there was this gentleman called Edwin Coppock, Edwin Coppock, who came forward and undertook this task. As a primary research background check, he started asking all the confessional priests as to what people confess about their grief. And the priest told him that the highest level of grief is faced by a destitute or a poor widow who has no children. She is the hardest hit. But even in that case, the widow invariably gets up and starts picking up the threads of her life within 12 to 15 months. So Edwin Coppock's logic was, if we can get over death of a near and dear beloved relative between 12 to 15 months, a bear market should not ideally last more than 12 to 15 months. And you know what, Rennie? He was proved right. The Church of England made a lot of money based on this hypothesis, and history has time and again proved Edwin Coppock right, to the extent that there is, even in technical analysis, an Edwin Coppock oscillator. So if you were to actually time the market, it would be a wise guess to think that probably 12 to 15 months is a maximum period of a drawdown that I would see from the beginning of the down move.
Sounds interesting. Sir, now how should one protect themselves from the global recession? Now I know that you are bullish on gold. So does your view on gold and other commodities remain intact?
Absolutely, Reddy. I think the more currencies get volatile, the more return on financial assets get contracted and compressed, you will see a flight towards safety of gold. And gold prices will give a higher and higher return. May not really double and triple from here because that's not what gold is for. It's more to hide in, more to protect the value of your money and earn a little bit of an income also by and by. So I would think gold would be a safe refuge. Silver, again, like I've said, if you're allocating 100 rupees towards bullion, by all means invest 60 to 70 rupees in gold and 30 to 40 rupees in silver. So it's a hedge. And then, of course, in financial assets, step away from high leverage. Do not attempt to make quick money. Do not succumb to temptation of excessive leverage and trying to buy beyond your means. That is a strict no-no.
All right. Thank you, Vijay sir. Thanks a lot for your valuable insights. So, guys, stay tuned for more updates. Don't forget to subscribe to our YouTube channel and click on the notification bell so that you guys don't miss any of our updates. Thank you.
Thank you.